Thanks for clicking. London's real estate market continued to slide in July, according to new data just released by the London and St. Thomas Association of Realtors, or LSTAR. With the benchmark average and median price of a home in London all falling throughout July, clearly London's market is following the trend set by the rest of Canada, which RBC says is set for a major historic correction. With mortgage rates inching down, though slowly, affordability has actually gotten better in the London and St. Thomas region, requiring smaller down payments and less household income than was required at the peak of the market in February. So what I want to do today is go over London's real estate data, look at how much households need to earn to purchase at these new slumping prices, especially compared with that of February, and then take a look at what to look for next. As we'll see, mortgage rates have been dropping, and that has definitely helped with housing affordability in the London area. We'll continue to have updates out on London's real estate market and Canada's real estate market as a whole on this channel. If you want to get those updates, make sure you click like and subscribe. But for now, let's get into LSTAR's report. First off, the benchmark price. The benchmark price being the price of the home, which represents the most popular set of features in the London and St. Thomas area. The benchmark price of a home in London and St. Thomas went down to $624,400 in the month of July, down almost $120,000 since its peak in February of $749,000. So in just over 4 months, we've seen a $120,000 decline in our benchmark price. And we're also seeing this in the average price. The average price of a home in London in July was $673,606, which was down from February's peak of $823,000. So that's a drop of nearly $150,000 in the average price of a home in London in just over 5 months. And we're also seeing major price drops in the median price of a home in London. The median price, remember, that's where half as many homes were sold for over that price and half as many were sold for under that price. Our median price of a home in London dropped down to $590,000 in July, down from its peak of $777,000 that we saw in February. So that's a $180,000 price drop in the median price of a home in London in just over 5 months. And it makes sense when we look at the sales to list price ratio. The sales to list price ratio measures how much houses go over asking price. So if the asking price is 100 and the house sells for 105, the sales to list price ratio is 105. For the first time in a lot of people's memories, the sales to list price ratio was less than 100 in July, plunging down to 98.9. To give a bit of context, the sales to list price ratio in February was 125.6. So on average in February, London's housing went for 25% over asking price. And now on average, London's houses are going for 1.1% under asking price. So that represents a major shift in London's housing market in just a little over 5 months. From 26% over asking price to 1% under asking price on average. That's a big shift in our market, and we can definitely see the power moving back over to the buyers. This is no longer a seller's market, and we can see that when we look at the months of inventory. The months of inventory measurement, that's if no more homes came to market, how long would it take for all of our homes to sell? In July, that number was at 3.2. So if no new homes came to market, it would take 3.2 months for us to be out of homes for sale. And just to give, again, more context to that, in February, at the peak of the market, we only had 0.5 months of inventory. So we definitely have much more inventory available, and that's obviously put major downward pressure on our prices. So our benchmark average and median house price have all plummeted well over $100,000 since their February peaks, some over $150,000 since those peaks. We have our houses selling for under asking price, and we have 6 times more inventory available than we had in February. Clearly, the market has shifted in the favor of the buyer. But has this made housing any more affordable in London? Affordability has actually gotten better in London, especially since mortgage rates started dropping following the release of Canada's better than expected inflation rate of 8.1%. Better than expected because it wasn't 8.4%, but better than expected nonetheless. Let's take a look at the average price in London. If we take the average price of a home in London in February was $823,000, and we qualify at 5.25%. Back then, rates were so low we could still use 5.25, and we use a 25-year amortization with minimum down payment requirements. Households had to earn $175,000 in order to afford that average house price. Now, if we look at that same average house price in London in July of $673,000 and change, and we use a qualifying rate of 6.49%, 2% above the contract rate of 4.49, that's fairly decent for a 5-year fixed these days. If we look at that based off minimum down payment requirements, the minimum amount of income needed by a household with zero debt is $165,000, or $10,000 less needed in household income to buy that same average house. Now let's take a look at the benchmark price, the benchmark price being that house that has the most popular set of features. The benchmark price of a home in London in February was $749,000. Using minimum down payment requirements and a qualifying interest rate of 5.25 and zero debt, the household income required to get that benchmark price was $160,000. Now, using July's data, in July's benchmark price of $624,000, using minimum down payment requirements and that qualification of 6.49, the income required to get that benchmark home in London is now $150,000. Again, another $10,000 decrease to get the benchmark house in London, to get that most popular house. So, for the average and benchmark house price in London, buyers now need to earn $10,000 less than they did in February, not to mention much smaller down payments are required as well. However, like we said earlier, this decrease in the mortgage rates is due in large part to the better than expected inflation data. The better than expected inflation data caused bond yields to fall as investors thought the Bank of Canada will be stopping their rate hiking cycle in the near to mid-term future. Whether or not this is the case is going to be anybody's guess, and this will be largely dependent on Canada's inflation rate going forward. While our inflation rate is expected to be back down in the 7% range, as we have seen an ease in gas prices, there are other inflationary pressures at work that we've talked about on this channel before, wage demands, etc. So whether or not the Bank of Canada is going to be finished with this rate hiking cycle in the next few months is still unclear. It is going to be largely dependent on our inflation rate. And as such, these mortgage rates that we're seeing, these decrease in mortgage rates that we've seen over the past couple of weeks, whether or not they'll stay permanent is going to be largely dependent on the inflation data. So, for first-time home buyers, for any home buyers really, the best thing you can do is get your rate holds in place. Most rate holds last for 120 days, so if you can get that rate hold locked in place now, when it comes time that you have an accepted offer, most lenders will give you the best rate at the time. They'll either give you the rate hold that you have in place, or if rates are lower, you can get that lower rate as well. So you do get the best of both worlds if just by getting those rate holds in place, and the sooner you have that ready, you can take advantage of those lower prices that look like they're not going to be stopping anytime soon. We will obviously have updates out on this channel on Canada's inflation rate, which is going to have a big impact on mortgage rates, which will obviously have a major impact on our real estate market going forward. If you want to get those updates, make sure you click like and subscribe. But for now, thanks so much for watching.